Welcome to the Deep Dive. Today, we're jumping into something pretty fascinating. The 2005 shareholder letter from Fairfax Financial Holdings. This thing details what they called an annus horribilis, a truly terrible year.
Yeah, it's this incredible document because, you see the headline number right away. A record loss of $498 million in 2005, just huge.
Almost $500 million, and that hit shareholders hard, right?
Yeah.
Equity dropped. What was it?
Almost 18%. Yeah, 17.9% wiped off shareholder equity in just 1 year. You'd think, okay, panic stations.
But that's the twist, isn't it?
Ah.
They framed this year of, massive losses as proof their whole long-term thing was working.
Exactly. It's like they zoomed straight out. They reminded everyone, look, yeah, 2005 was brutal, but over the last 20 years, from 1985 to 2005.
Numbers were insane.
Totally. Book value compounded at, get this, 25.9% per year. They turned $1.52 a share into over $151 a share. Just incredible long-term growth.
So that's our mission for you today. They actually called the period 1999 to 2005 their biblical 7 lean years. We want to explore how they got through that, especially that awful 2005, and why they sounded so confident, almost defiant, despite the massive hit.
Yeah, how do you lose $500 million and basically say, see, told you so? That's what we're digging into.
Okay, so let's start with the disaster itself. That $498 million loss in 2005, what was the main driver?
It was Mother Nature, basically. Just relentless. You're talking hurricanes, Katrina, Rita, and Wilma, all in the same season.
The big three.
The big three. The source material makes it crystal clear. Those storms cost Fairfax $716 million.
Directly.
Yeah.
$716 million.
And it wasn't just a Fairfax problem. This sequence of hurricanes, it was the single biggest loss event the entire property and casualty the P&C insurance industry had ever faced up to that point.
Okay, so when you have catastrophes that big, it must just hammer your core insurance metrics, like the combined ratio.
Oh, absolutely crushes it. Fairfax's consolidated combined ratio shot up to 107.6% for 2005.
And for listeners maybe not deep in insurance jargon, what does 107.6% actually mean in simple terms?
It means pain. Basically, the combined ratio adds up your claims costs and your operating expenses divided by the premiums you took in. Over 100% means you're losing money just on the basic business of insuring things.
Right.
So for every dollar they collected in premiums, they were paying out about $1.08 in claims and running costs. They were in the red before they even looked at their investments.
And the letter actually breaks down how much of that was just from those storms.
It does. Those 3 hurricanes alone added 13.9 percentage points to that ratio. 13.9.
Just incredible. How does that compare to other big events they'd faced?
Well, think about it. The source mentions the 2004 hurricane season cost them 5.1 points. Big, but not close. And the World Trade Center tragedy back in 2001, that was 4.9 points in their combined ratio.
So 2005 was almost triple the impact of 9/11 on their underwriting results.
In terms of the hit to the combined ratio, yeah, it was just off the charts bad.
So, okay, they get hit with this absolute monster year, on top of the 6 tough years before it. This brings us to that 7 lean years idea, right? 1999 to 2005. What was the final score after all that?
This is the amazing part. You look at those 7 years cumulatively, pre-tax, and they basically broke even. The total pre-tax loss over the entire 7-year period was only $0.2 billion, $200 million.
After absorbing Katrina, Rita, Wilma, 9/11, all of it. How is that even possible? How do they pull that off?
Well, it wasn't magic. It was the model working exactly like they planned. The investment side of the business acted as this massive shock absorber.
Okay.
Over those 7 years, they generated $5.3 billion in investment income, plus another $2.4 billion in realized gains from selling investments.
$7.7 billion in investment profit.
Exactly. And that $7.7 billion was more than enough to cover the $4.4 billion in total underwriting losses they took over that same 7-year stretch. And those losses included all those massive catastrophes we talked about. The investments carried the load.
Right. But the letter also makes a point that it wasn't just the investments saving them. They were building strong underlying insurance businesses during this tough time. Let's talk about that underwriting strength. Companies like Northbridge, Crum & Forster, Odyssey.
Yeah, absolutely. They really highlight Northbridge, their Canadian operation, as kind of the star pupil.
Gold standard.
Pretty much.
Yeah.
Between 2002 and 2005, Northbridge averaged a combined ratio of 92.7%. Consistently profitable underwriting. which is what you want to see.
Meaning they made money before investments.
Exactly. And crucially, they also point out Northbridge's reserving discipline. Over the previous 10 years, they had averaged a 4.8% redundancy in their reserves each year.
Meaning they consistently set aside a bit more than they ultimately needed. A safety cushion.
Precisely, a sign of conservative, prudent management. Then you look at the U.S., Crum and Forster, a tougher market, obviously. Its combined ratio over those 4 years was 105.2%, so an underwriting loss overall. But the letter stresses, if you pull out the massive hurricane effects from '04 and '05, the underlying performance, the accident year basis, was actually a solid 93.0%.
So the core business was sound. It was just these huge outlier events that skewed the headline number.
That's the picture they paint. And this ties into another key area, managing old liabilities, the runoff unit.
Right. This is for business lines they stopped writing, like TIG insurance.
Exactly. Stuff they acquired or discontinued. And managing that runoff well is critical. They showed good progress there. The net reserves tied up in runoff dropped from 46% of their total reserves in 2001 down to 26% by the end of 2005.
So shrinking the problem.
Shrinking the problem significantly. And they actually expressed hope that the runoff unit might finally approach break-even in 2006 for the first time since they put TIG into runoff late in '02. That would be a big milestone.
Okay, let's connect this back.
Sure. Float is basically money insurance companies hold temporarily. Think premiums collected but not yet paid out as claims, or loss reserves set aside for future claims. They get to invest this float for their own benefit.
And their float grew in 2005?
It did. The average float from their operating companies was up 23.5%. Sounds great, right? Way to invest.
But there's always a but.
There's always a but. The cost of that float in 2005 has spiked to 5.0% because of those massive hurricane claims they had to pay out.
What does cost of float mean?
It's essentially the underwriting loss expressed as a percentage of the float. So in 2005, for every dollar of float they held, it effectively cost them 5 cents because of the underwriting losses.
That seems high. Is that normal?
No, that's high. But, and this is key, it was an anomaly driven by the hurricanes. The letter puts it in perspective. Since they started back in 1985, their weighted average cost of float was 4.5%.
Okay.
And crucially, that 4.5% average cost was lower than the yield on long-term Canadian government bonds over the same period, which was 5.7%.
So historically, they were getting capital to invest more cheaply than the government could borrow. That's the power of the insurance model done right.
That's the goal. Discipline makes it happen.
Okay, so the underwriting house was proving resilient, but surviving a $716 million hit requires more than just good underwriting. It leads us straight to their investment strategy, which was famously cautious, paranoid even.
Yeah, conservative is an understatement sometimes. In 2005, their stance was defined by extreme caution. They weren't chasing high yields. They held huge amounts of cash and short-term investments. And importantly, they were actively hedging against stock market drops.
Deliberately sacrificing potential returns for safety.
Absolutely. They were choosing capital protection over immediate income.
But didn't that cost them? I mean, the market was still doing okay then. The letter even calculates that just a 1% higher yield would have meant an extra $142 million in income that year. How did they justify sitting on all that cash?
They justified it with what they called the catastrophe lesson. It was non-negotiable for them. Their absolute core rule of risk management was any single worst-case catastrophe loss must be containable within 1 year's investment income.
Okay, so if a disaster costs more than you make from investments in a year, you're in existential trouble.
That's the line in the sand. If you cross it, the company itself could be at risk. They saw it as avoiding ruin.
And they had examples to back this up, right?
Oh, yeah. They pointed to the 1994 Northridge earthquake, which basically wiped out $700 million of capital at 20th Century Insurance, nearly killed the company.
Wow.
And Hurricane Andrew in '92, which famously erased something like 50 years of Allstate's profits in Florida. These aren't theoretical risks.
Right. They're real-world company-ending events if you're not prepared.
Exactly. So paying that opportunity cost, that $142 million in foregone yield, was seen as the price of ensuring they lived to fight another day. Survival first.
And we should probably mention, despite this cautious overall stance in 2005, their long-term investment managers, Hamble and Watsa, had a phenomenal track record.
Yeah, the letter touches on that. Over 15 years, for example, their U.S. stock picks compounded at 19.8% per year, compared to the S&P 500's 11.5%. So the caution was strategic positioning, not a lack of investment skill. Okay, now let's get to a really interesting part. The specific defensive moves they made, the hedges, which were costing them money in 2005, but were placed because they expected trouble ahead.
Right. They were preparing for what they called a 1-in-50-year or 1-in-100-year event. How did they do that?
Well, they hedged about half their stock exposure against the S&P 500, but the really big conviction bet was in the credit markets. They bought around $250 million worth of credit default swaps, CDS.
CDS. Those became famous or infamous later on.
They certainly did, but back in 2005, this was quite forward-looking, and that $250 million in CDS premium gave them protection on something like 40 times that amount of underlying credit exposure. Huge leverage.
Can you break down how a CDS works, maybe using their example? Keep it simple for us.
Yeah, the source gives a good illustration. Imagine you pay, say, $1.5 million. That payment buys you 5 years of protection on $100 million worth of bonds or loans, the credit exposure.
Okay.
If those bonds or loans default or have some other credit event, your protection contract pays out, potentially up to the full $100 million face value. If nothing bad happens, you just lose the $1.5 million premium you paid. It's like buying fire insurance on someone else's financial house.
Got it. So they were buying insurance against a broad financial meltdown, specifically in the credit markets.
Exactly. Systemic risk insurance.
But here's the kicker. In 2005, the meltdown hadn't happened yet.
Yeah.
So why were these hedges costing them money on their income statement? That seems counterintuitive.
Welcome to the wonderful world of mark-to-market accounting, or GAAP. They couldn't just buy the insurance and wait. Accounting rules forced them to value these CDS contracts every quarter.
And since the market hadn't crashed yet.
Right. Since credit spreads were still relatively tight, the market value of their protection hadn't gone up much, or might even gone down slightly. So they had to record the premium they paid, plus any unrealized loss on the value of the CDS itself. And here's the weird part. GAAP made them book these unrealized hedge losses as realized losses in their earnings.
That sounds painful. What was the total damage from these hedges?
It was massive. Between the stock hedges and the CDS, the total cost hitting their earnings over the 3 years from 2003 to 2005 was $249.4 million.
$250 million just gone from earnings as the price for protection against something that hadn't occurred yet.
That's the cost of conviction. They saw it as a non-negotiable insurance premium on their entire balance sheet, protecting them against what they believed was inevitably coming.
And this belief, this conviction, led them to issue some pretty stark warnings in that 2005 letter.
Like an oracle.
Yeah, reading it now, it's genuinely chilling how accurate they were. They explicitly pointed to clear signs of a housing bubble.
In 2005. In 2005, they noted the U.S. consumer was stretched way too thin, with the personal savings rate actually below zero, people spending more than they earned.
And they had a specific warning about the stock market too, right?
Yeah.
Something about GDP.
Yes. This is a big one. They pointed out that the total value of the U.S. stock market, the market capitalization, was hovering around 120% of the country's GDP.
Which is high.
Historically, extremely high. The long-term average over 80 years was about 58% of GDP. Even at the infamous peak in 1929, it only hit 87%. So 120% looked really dangerous to them.
They were basically calling the top, or close to it, warning about regression to the mean.
Precisely. They saw unusually high corporate profit margins and said, essentially, this can't last. Things tend to revert back to average. They were positioning the company for that reversion. And of course, making these kinds of expensive multi-year bets like the CDS, while also absorbing massive hurricane losses. Well, that all depends entirely on having a rock-solid balance sheet.
You need the financial muscle to withstand the pressure. How do they ensure they had that flexibility?
Well, they proactively shored things up. In 2005, they raised $300 million by issuing new equity, specifically to boost the cash held at the holding company level.
And despite the huge loss for the year, how did their overall debt look?
Remarkably stable, actually. Their net debt-to-equity ratio only ticked up slightly, from 49% at the end of 2004 to 53% at the end of 2005. Pretty resilient.
And liquidity. Cash on hand.
That was a big focus. They ended 2005 with $559 million in cash, short-term investments, and marketable securities just at the holding company. Plenty of readily available funds.
Gives them breathing room.
A lot of breathing room. And crucially, the holding company itself didn't have any major debt repayments coming due until way out in 2012. That long runway was vital. They could afford to be patient.
The structure of the group helped too, didn't it? With some subsidiaries being public companies.
Yes, that's another layer of flexibility. Northbridge and Odyssey were publicly traded. That meant they had their own independent access to the capital markets if they needed funds.
They weren't solely reliant on the parent company.
Exactly, and the letter notes that Odyssey actually used that access in 2005. After the hurricanes hit, it went out and raised $200 million through selling its own stock to replenish its capital base. That decentralization adds a lot of strength.
Okay, so let's try and pull this all together. What's the big takeaway for us looking back at this 2005 letter?
I think the core message is that that huge headline-grabbing loss in 2005 wasn't a sign of failure. It was actually the predicted and accepted cost of sticking to a disciplined, long-term strategy focused on survival.
Right. The fact they could absorb that hit and still break even over the full 7 lean years proved the model worked, even under incredible stress. They chose resilience over maximizing short-term profits.
Absolutely. And they were incredibly upfront about paying for that resilience, that $250 million cost for the hedges over 3 years. The letter basically frames it as short-term losses for long-term realized gains.
They were willing to look wrong, or at least unprofitable on those bets in the short term.
Because of their conviction about the risks they saw, the housing bubble, the credit expansion, the market valuation was just that strong. They were playing a longer game.
Which leads us perfectly into our final provocative thought for you, the listener. Think about this. In 2005, they laid out these explicit warnings: housing bubble, 120% market cap to GDP. They spent $249 million preparing for exactly that scenario.
The question becomes, what happened next? Given that level of foresight and that willingness to bear the short-term pain, how massive was the payoff when those expensive hedges finally flipped from being unrealized losses to presumably huge realized gains?
And how long did that conviction take to ultimately be vindicated? As Fairfax themselves wrote, the game of long-term survival wasn't over yet.
Indeed. Something to think about.
Definitely something to think about.
Thanks for joining us.